We all know about credit scores, that three-digit number that seems to control so much. But what if I told you the score is just the tip of the iceberg? Today, we're diving deep into the credit report itself, the extensive document that lenders actually scrutinize. By the end, you'll understand exactly what's inside yours, why it's so important, and how it impacts your financial life far beyond that single number. First, let's nail down the basics. Your credit score, like a FICO score or Vantage score, is a statistical summary. It's a quick snapshot, a numerical representation, of the information contained within your much larger credit report at a specific point in time. Think of it as a grade on a test. Your credit report, on the other hand, is the full test paper with all the questions, your answers, and the detailed breakdown of how you got that grade. It's a comprehensive record of your borrowing and repayment history over many years, compiled by one of the three major credit bureaus, Experian, Equifax, or TransUnion. These bureaus collect information from lenders, utility companies, and other creditors, creating a detailed ledger of your financial reliability. It's essentially your financial resume, detailing how well you've managed borrowed money. This is what lenders truly analyze when deciding whether to lend you money, and on what terms. A common misconception is that you have just one credit score. In reality, you have many scores, generated by different models, like FICO 8, FICO 9, Vantage Score 3.0, etc., and based on the data from each of the three bureaus. Each bureau might have slightly different information, leading to slightly different scores. So, what exactly is inside this crucial document? Your credit report is typically broken down into four main sections. The first is your personal information, which includes your name, addresses, social security number, and employment history. This section helps confirm your identity. Next, and perhaps most important, is the account information section. This details every credit account you've ever held: credit cards, auto loans, mortgages, student loans. For each account, you'll see the date opened, the credit limit or loan amount, the current balance, and crucially, your payment history. For example, if you have a credit card with a $5,000 limit, the report shows that limit, your current balance, say $1,500, and a month-by-month history of whether you paid on time, late, or missed payments entirely. This granular data on every single account is gold for lenders. The third section is public records. This can include bankruptcies, foreclosures, or tax liens. These are serious financial events that significantly impact your creditworthiness and remain on your report for many years. It's a clear signal to lenders about severe financial distress. Finally, we have inquiries. This section lists every entity that has recently requested to view your credit report. There are two types: hard inquiries, when you apply for new credit, and soft inquiries, like checking your own credit or pre-approved offers. Hard inquiries can slightly lower your score for a short period. An important caveat: medical debts generally appear on your credit report, but recent changes have made them less impactful. Paid medical debt is now removed, and unpaid medical debt under $500 won't appear. This highlights how credit reporting rules can evolve. So, why does any of this matter to you? Your credit report dictates your access to credit and the cost of that credit. A strong report means you're seen as a reliable borrower, leading to better interest rates on loans and higher credit limits. Imagine applying for a $300,000 mortgage. If your credit report shows consistent on-time payments and low credit utilization, you might qualify for an interest rate of 6%. Over 30 years, that's a significant saving. However, if your report shows multiple late payments and high credit card balances, you might only qualify for a 7% rate, or even be denied. That 1 percentage point difference on a large loan translates to tens of thousands of dollars more paid over the life of the loan. It's not just about loans. Landlords often check credit reports before approving rental applications. Utility companies might require a deposit if your credit history is shaky. Even some employers review credit reports for certain positions, especially those handling money. Your credit report also plays a critical role in detecting identity theft. If you spot accounts you didn't open or inquiries you didn't authorize, it's a red flag that someone might be using your personal information fraudulently. This is why regular review is essential. A major misconception is that closing old accounts with a perfect payment history is good for your score. In fact, closing old, positively aged accounts can reduce the average age of your credit, which can negatively impact your score. Length of credit history is a significant factor. Another common belief is that carrying a small balance on your credit card helps your score. This isn't true. While it shows activity, paying your balance in full every month is always the best strategy to avoid interest and maintain low credit utilization, which is key for a good score. Also, many think checking your own credit report hurts your score. This is false. Checking your own report, known as a soft inquiry, has no impact on your credit score. You can and should check it as often as you like, which brings us to our next point. So, what's the practical takeaway? First, proactively obtain and review your credit reports. You're legally entitled to one free credit report per year from each of the three major bureaus, Experian, Equifax, and TransUnion, via annualcreditreport.com. Stagger your requests throughout the year. For example, pull your Experian report in January, Equifax in May, and TransUnion in September. This allows you to monitor your credit information regularly without cost, and catch errors or fraud early. Second, dispute any inaccuracies immediately. If you find an account you don't recognize, a late payment that was actually on time, or incorrect personal information, contact the credit bureau and the lender to have it investigated and corrected. Accurate information is paramount. Third, cultivate positive credit habits. Always pay your bills on time, keep your credit card balances low relative to your limits, ideally below 30% utilization, and only open new credit accounts when genuinely needed. These are the building blocks of a robust credit report. Remember, your credit score is merely a numerical reflection. Your credit report is the comprehensive narrative of your financial responsibility. Understanding this distinction empowers you to take control of your financial future, negotiate better terms, and protect yourself from fraud. So, don't just know your score. Understand the full story behind it. What's one thing you found surprising about credit reports today? Share your thoughts in the comments below, and if you found this deep dive helpful, hit that subscribe button for more straightforward financial education.